And I'll go back on mute if you're going to do that.
Oh
Okay.
no, it's great. The more conversation, the better, really.
Okay, so we are recording. So welcome everyone to the first Sleepwell Portfolio Q&A. It's open to everyone. So if you're new to the Sleepwell and you have a question, this is a good place to ask it. If you're a subscriber and you want to know how to set up an allocation or any questions that you may have, this is a good place for that. So welcome everyone. Glad to see you here.
Yeah, welcome, welcome. I'm glad to see some faces, some names that I'm familiar with, and some that are new. So that's always exciting. So I had this kind of slotted out. Tom and I, talked about this and kind of threw it out as an idea to see if there was some hidden questions that maybe haven't been coming up because of just the medium of like a forum or email back and forth. And some people kind of like to get on a call or a web, and answering things sometimes can be a lot faster in groups than it can be in individual format. So this is where we're at. And so because it's the first meeting, I haven't exactly had a bunch of people send me things, although there's things that I've had other members get hung up on a little bit, and so I can of course go down those roads or anything like that. But for right now, I mean, really just to kind of open it up to anyone that's got questions, comments, wants to talk about things. The one thing that I will clarify just first right off the bat on this meeting is, since it is open to public, uh, we're not going to talk about what the allocations are at this moment. Tom, did you get a demo account set up to where?
Well, I got the demo login, but then I'm still working on the code to just show like dummy data or just like, back in time or something. So it's
Okay.
not quite ready yet.
Okay. Well, that's okay, because I think I can make a workaround for that. If there's a question about allocations and stuff like that, I'll have to do some fancy work with sharing screen, unsharing screen, fixing things, then sharing screen again.
I'll take a screenshot and then blank stuff out and then show it.
Yeah, something like that, exactly. But we are, just for future references and stuff like that. Tom is working on something where we won't show live allocations and stuff like that. And just to kind of clarify, the reason why we open this up to the public is there's a lot of people out there that maybe aren't members, or maybe have members and then dropped off because they had some struggles with maybe the online software or just managing it in general. And those are really those kinds of questions that we want to hit up and tackle in these types of things. And so something that we can do about that is always great. And then of course, there are some people that are members, and this is just a better forum for them to get their questions answered. So like I
I
said,
did want to share like this history page I'm working on. Now this one's for the public. I'll put the link in the chat here. So you don't have to be logged in for this. If you are like logged into the new member site, it'll show like a link back to the home. Otherwise, it'll show you links to the information page, sales page. But this is using those new high charts, which is the same ones that like Vic Central uses. And if you look on the, actually, I guess I could probably share my screen. Here we go. So can you see my screen now?
Mm-hmm.
Okay, so this little hamburger menu, if you click on it, you can actually download an image, a PNG, JPEG, a PDF, a SVG vector image, or the CVS or XLS data in a spreadsheet format. So you can put it in full screen or print it. So there's lots of nice little things you can do with this. And if you mouse over it, you can see all the actual data, and then it works the same on all these charts. So this is the weekly yields. I guess I need to put a title on this. This is wrong. The allocation of this ends 3 months ago. So the current subscribers obviously will get the whole thing, but this is to give you an idea how the Sleepwell works with the different allocations, how it changes over time based on Wayne's analysis of the macroeconomic environment. The drawdown chart, this is, again, since we started, this is like our 1-year anniversary. So this is how it's done since then. You can see, here we had that pretty big move down with the spiders versus the Sleepwell was only down 2% versus 8%. So that's pretty nice.
Yeah, I
It's
mean,
been kind of,
something always nice about that little graph down there is you'll see, even right now, we've recently kind of matched the S&P, slightly exceeded it, stuff like that. We're not necessarily always trying to compete directly against the S&P, but the whole thing that's nice about that is it does give us an anchor point to kind of see what's going on. You'll see big divergences when you start to see like large drawdowns in the S&P, and that's because of exactly kind of what's going on right now for members that are here. Is that we've rotated into this correction, whereas in many other corrections we won't rotate and we'll be really bullish. So it's just kind of an adaptive strategy, exactly what we talked about. Go on, Tom, though. This is awesome.
and then here's the new and improved, I guess the sleep ball versus the spiders, the risk parity, and the 60/40 portfolios. So you
Yeah.
can
Hey,
see how those are doing.
Can you
Tom, of
hold
course,
that?
I've
Can you
always
hold
got.
that one just for a second, Tom? Just a quick question here. I know sometimes we run into the 2x and the 3x allocations. I don't know how much code you've got behind this. Would it be difficult to add just a straight 2x or a straight 3x to add 2 more lines to this graph?
Yeah, I can probably do that. It's a little bit challenging to calculate that, but I can definitely do it.
Well, if it's too much, don't. Okay, I'm wondering if it was something real easy, just pick up a couple more equities in there for the 2x and the 3x.
Well, I have
Or
to,
those.
yeah, I have to run some calculations to calculate what the net asset value is each day, and
Oh.
it shouldn't be too hard to do, but it's definitely doable.
Well, make it low on the priority list then. It was just a question.
Okay.
You're not the first person to ask that, though. That's actually been a pretty common question, because something that it's always a surprising information to hear how many people actually do leverage. So I know, I mean, I leverage and everything like that. I always thought that I was kind of a more risky individual with, some conservative natures, but there's a lot of leverage out there. So people are pretty comfortable with it and things like that. And so it's something that a lot of people have been like, hey, I want to know what the base 2x or the base 3x is doing compared to me. And not even talking about the more complicated leveraging, like, the selective leverage, which Laz, we're going to talk about that here in a little while after we're kind of done going about that, because I saw your question come through.
So that's definitely on the roadmap. One thing, I don't want to show this allocations page because it has all the current allocations,
Right.
but there's a drop down on it for the model portfolio and then the portfolio that you have. And I'm in the process of adding where you can have multiple portfolios, 1, 2, 3, 10, whatever.
Tom, I mean, it's not like we're ashamed of our allocations or anything like that. So I mean, we can throw it out there this week, and just as soon as you get them all set up, we'll
Okay,
get it all to
well,
where they're more randomized. But I mean, these are going to change pretty dramatically over the next couple of weeks because of the volatility. So
this shows you the previous and current allocations in a pie chart, which I thought was kind of cool. And then I think I took off the buy share sells here, the number of shares that you buy and sell. Probably I'm going to only have it on Tuesdays because it doesn't make sense to have it on like Thursday, Friday, whatever, because you've already executed it. I don't know. What do you think on that? I can leave it there, but
Or you can just break out your calculator and add A plus B or subtract A minus B.
Well, I definitely think that that's the whole goal behind this sheet, is definitely to have the how many buys and sells. I mean, I use that. I mean, granted, I use the management sheet and the onlines.
Well, I would only show it on Monday and Tuesday.
Right. That would be perfect. Now for for a member, it's just whenever they can leave theirs down there all the time. I mean, that helps them, right?
Yeah, I could leave it in. That's not a problem.
Yeah.
But here's the drop down I was talking about. So here's another one I was just kind of goofing around with. I've only put one entry in, but this will be the kind of thing you'll get the same type of information, and you'll be able to have. Right now, everybody just has one portfolio, but I'm building in the capability so you can have n number. You want 1, 2, 3, 5, 10, whatever. So that is coming. It's not too hard to code this up at this point. I just got to do the part where it's interfacing with the old site and the new site, because I've got a database on my Windows server, and then this site's using an Amazon cloud database. So anytime we update stuff on my server, it has to push it to 2 databases, and it gets a little complicated, but Long term, this will be kind of where we're going, but
That's been a big request is, hey, let me have another, let me at least do 2 portfolios. And then, hey, if I need to do like 3 or 5, they're like, hey, I'll pay for an extra, a couple dollars to do that or something like that. So that's always something that we've been working on. It's exciting that you're getting there.
and this page will also have that same drop down. So you'll be able to see a history of the model like this, and then also pull down yours and see your allocation history and all the charts and performance and everything. So that's I've written a bunch of classes and everything. So it's all going to be kind of seamlessly easy to do once they kind of finalize it, but it's getting there for sure.
Beautiful. And yeah, I love this new site. I love the high charts and everything that you added in. It's still clean and simple, it's not fluffy and
It's
super
fast too.
right. It's not full of a bunch of junk when we're looking at it. It's clean. I know it's very utilitarian. It works really well.
And before I forget, this is, if you notice, look at the dates here. So this is today is the 1-year anniversary. So we came up with this 1-year anniversary sale, which is the same sale we had back in April, where if you're new and you subscribe for a year, you get 3 free months. If you subscribe for a quarter, you get 2. If you subscribe for a month, you get 1 free month. But that's for any new subscriber. That's now available for the next couple days. I guess I have it set till October 3rd, but Wayne, we can change that. I don't know.
October 3rd works good. I mean, yeah, it's just meant to be a little flash sale. I never wanted it to be like something that we constantly put this portfolio on sale, because it's already such a good deal compared to having a financial manager or even some similar services that just kind of give you like a junk portfolio to follow. They're not adaptive, all sorts of things. So it's such a good deal that it's kind of like but I'm like, I really do like to put some things out there, throw some good deals for people that have maybe been looking, sitting on the sidelines, and it's something exciting that's like, hey, look, I can get a little bit stuff to get me going and just kind of push you over that hill. There's so many people that are just like, hey, when's the next sale or something like that. And I'm like, well, you know what? Our 1-year anniversary sounds like a good one. So
Now this is interesting too, this leverage. So Wayne, you want to explain what that is and how people use it?
yeah, because actually that's Laz's question right here. So originally, so you have access to the forums on here, right, Tom?
I can go to the forums, yeah.
Or at least we can pull it up. I
Let's
can
see.
probably.
Oh, that's
Well,
interesting. I don't
you
think
know
I have a
what?
forum link here. I can
I've
just go
got.
there.
Hold on. I've actually got an Excel spreadsheet that I can just like pull over.
Well, you want to share your screen then?
Yeah, that's what I'm gonna do. So
That's probably easier.
see, not that this is gonna be. Yeah. Actually, here, yeah. Let me just pull up the charts right on the forums.
While you're dragging that up, Wayne, just another quick question. I know some content providers at a 1-year mark or at the beginning of the year will reset to a base figure. Are you planning on doing that, or are you planning on just letting this accumulate from inception to Y2D?
Yeah, great question, Tom. So I'm actually always surprised at how much people ask this, and Tom's even asked that. He's like, hey, we'll reset it and everything like that. I'm a fan of letting it rip. I kind of want to. The whole premise behind this, and my personal, or just in my mentality, is it's always kind of driven me nuts that other content providers reset, because it's like, I feel that it's doing it a little bit of a disservice, because the compounding growth of a long-term portfolio that grows over time is that's where the true power is. I mean, in 3 and 4 years, this thing will be huge. I mean, I might have to eventually reset it, because I'm like, I don't know, maybe we're at like a 500,000 or something like that. And it's just like, hey, let me reset it for new timers. Or actually what I would probably do at that point is I would say, hey, I'm just going to start up a second one that just follows us with a smaller account. So that way, and just to kind of help out with newcomers and stuff like that. But if I start noticing that it's a deterrent for, newcomers or something like that, and they want something that's a smaller account,
Mhm.
I'm totally willing to do that. There's nothing wrong with that. So
I'm just curious on that. I mean, if you want to wait until you get bragging rights and then reset it, that would be good.
no, no,
But
it's
you know,
definitely.
with my allocations and with the percentages you provide, it's just as easy to adjust it to whatever amount you're willing to allocate to this methodology.
Yeah, it's
Yeah,
just a
that
percentage.
that's
Yeah.
exactly the goal, is that, like, so unlike some options trades or some trades here and there, like even trying to do selective stock picks and stuff like that. It's like, well, okay, I need this many shares, but I've got this big of a portfolio. How do I do that? And so
Mhm.
that's why I do things in allocations based, because when you're managing money, I mean, that's how you do everything, because it's the only thing that scales. So I figure if I can just let it rip and take it all the way up to, I mean, 10 years from now, I mean, this thing will still be cranking along, and it'll be some pretty like stupid numbers, and some people might be like, I don't believe that, but they could go back through the track record and sit there and go, hey, look, this
Well,
is how you grow money over time.
Tom and I were talking about buying an island. So once you can buy an island, maybe you want to reset it then.
Yeah, sure. Yeah. I mean, what what might end up taking place is, it might just be like, we really, Tom and I have talked about, starting a fund with this or something like that. And so it might just get to the point where people are like, yeah, I don't really feel like managing it anymore. Let me just like throw it in a fund for all you guys.
Or ideally, just set up an ETF.
Yeah, that is something that we've talked about, because managed ETFs are kind of a hot thing right now. So there's been some discussion around it. We'll see if it ends up turning into anything. So I'd love to turn it into an ETF, because it would get to many, many more people. And what's great about it getting to more people is that we can reduce the per member cost, right, to like something smaller and smaller. So right now we're $60 a month with some discounts here and there, and even with sales like we've got going on right now, it reduces it. But eventually getting it to where it's even cheaper is really nice. So if we've got 100,000 subscribers, I'm gonna drop the membership price. Like, it's gonna happen. So I might actually, you might see it in the future as the service grows, that I'll drop it down just to kind of give back to everyone, and make it to where it's less costly for anyone.
It'll be more support too, so we can't drop it too far.
Right. Yeah, exactly. I mean, so it's
I
part,
gotta add
it's,
my 2 cents too, right?
yeah, exactly, Tom. You're like, hey, I'm working, yeah,
Wait,
because
you're giving me more work and giving me less money.
yeah, there's a business portion to it where it's just kind of like, I mean, because everyone knows, like, hey, I donate a certain amount of the proceeds, and so once it starts to just get to a certain point, you want to we want to make sure that, can we scale it? Great. Can we reduce the cost and make that scaling work well? And it's just one of those things. It's nice about the service. So here, let me share the screen really quick. I forgot about this because we got into the conversation. Let's see.
Yeah, talking about how the leverage works.
Yeah, exactly. Let's see, screen two. So this is in the forums. For anyone that's not familiar with the forums, you can go into the Sleep Well discussion forums. Anyone that's part of the service, you're going to get these. This is like a quick little strategy. So originally, what happened is I'd created the Sleep Well portfolio, and for years I had just been just letting it leverage over there to the side, and everything's been fine and dandy. And it's been kind of just a passive part of the portfolio, and I really focus a lot more on my shorter term trades and swing trades and options trades and things like that. So but someone had asked a simple question. No, it was no, actually, you know what it was, Tom, we were talking about Dan Harvey. And he had just made a comment in passing about when the portfolio had made it up to a new high water, that he was going to reduce an allocation, and then when it went down, he would increase an allocation.
Right.
I go, that's totally mean reversion, and it's brilliant. I love mean reversion, and mean reversion's active in markets. And then so I said that, well, knowing how the sleep well portfolio kind of functions and everything, I know it can be rather trendy. It doesn't necessarily always chop, but it is consistent. So what's nice about its consistency is it does lend to mean reversion. Whereas if you're familiar with like an asset that doesn't have mean reversion, it'll blow up if you try to mean revert it, because one trend will take you out. Something like the S&P 500 is really great mean reverting until it's not, because then you got these big fat tails and you've been mean reverting drawdowns, and then all of a sudden you blow out because you've got like a 30% drawdown or something like that. Something that's got consistent risk, like what the sleep well portfolio is, means you can mean revert. Now, I did do a roundtable on this, which Tom, I'm sure you have that link like handy because you're super guru over there.
I can look for
it. So we can probably throw it up in the chat, because the roundtable goes very, very much into detail on what I'm talking about here, and I give all these stats and everything like that. But the whole premise behind what you're seeing on the homepage, which is,
You want the one on leveraging leverage?
yes.
Okay.
So when you go to the Sleepwell homepage and you see this 4% drawdown, we can sit there and say, hey, what's the leverage ratio that we're at right now? Well, what I did here is I sat there and I went through the history of the Sleepwell portfolio, and I said, hey, okay, what levels are good to leverage up at? What levels create more return, less drawdown? Can we get more efficient? And basically, and this is a bad word always in data analysis and everything like that, but there is a curve fit to it, right? As long as the curve fit has a fundamental nature to it, which is the mean reversion around this consistency, it's a pretty sound strategy though. So I'm pretty comfortable with the curve fitting model, and I personally use it myself. And then I use it with the A.W.A.K.E now also, and the A.W.A.K.E will eventually come out to the public and things like that. There's still some beta testing going on with that. So, but yeah, basically what this comes down to is here's some of the stats and everything like that. But the strategy goes, when you draw down to 0.8, you go up to 2x leverage. And then when you get down to 6.5, which is a rather rare situation, it comes around so on average, it comes out once a year. We get a 6.5% drawdown. But that's not, it doesn't necessarily come in equal terms. So let's see, so if you look at drawdowns on the base sleep well portfolio, here is a Pareto chart down here, and I threw this on the forums too. So a Pareto chart down here, if anyone's not familiar with a Pareto chart, this is how often one of these numbers show up. So 0 to 1% shows up this many times, 0 to 2% shows up this many times, right? And so, and you can see as we get further along, a 10%, shows up almost nothing, so, right? 8 to 9% shows up just a few times. So, and the number of times it shows up is over here. Now, what this is counting is it's also counting up and down, right? So just take that into consideration, that it'll count a 1% drawdown on its way up, and then it'll also count the 1% drawdown on its way down. So that's why it's going to be a little bit skewed. But this Pareto chart will basically say your optimum efficiency, or your optimum frontier, right, starts to peak out right around 80%. And that's kind of the Pareto rule anyways, is around an 80% efficiency. And that's right around that 4% marker. So it's kind of ironic that the strategy like right now is currently at that optimum level. But once you get up to these 6.5s, this is a pretty rare occurrence up to 6.5. You're up in here around the 95%. So it's pretty rare to hit that guy. So yeah. And then drawdowns, you can kind of see across here, right? So to get up to around this 6% level, we go, this is in weeks right here. Down at the bottom, I don't have dates on here, but we can convert it. But basically this goes back to like mid 2007 all the way to just a few months ago. So, and you can see we went through roughly after this 6% drawdown, we went, roughly almost 3 years before getting another 6%, right? And then we get a pretty big nasty one in 2015. That is one weakness of the sleep well portfolio, is a very indecisive market that's chopping around. So like right now we have a very indecisive market, but now the chop is kind of gone and we're going into different things. So we'll see if that ends up popping out. But that is one weakness of the strategy, is just when we get really conflicting macroeconomic data a lot, and then all of a sudden it's just kind of back forth, and it starts pushing around the probability coefficients. So, and then yeah, we get, you know, one, and then we skip almost a year and a half, and then we get another one that tags 6. So it's pretty rare to get these 6% unless you get some really high volatility time periods. But anyway, so that's kind of the strategy behind it, and that's why that is on the homepage. Is just to kind of let you know, did we make it down to this level? Now, Tom, I believe you don't have it coded right now that it won't shift off this 2% until it gets back to high water. Is that right?
If it gets back to high, well, if it's less than the threshold for the 2x leverage, which is what, 0.8 something, then it'll shift back to 1x leverage.
Yeah, so that's one thing that's slightly misleading on this is did we trigger it? But it's not saying what the current one should be. So that's something to kind of note here. Tom, I mean, I don't know how difficult
I
it would
can
be
code that. Yeah, I can just keep track of it.
Yeah, just say, hey, you know, was the last check that we had a high water? If not, then stay at current leverage, right?
Although it might be different for a new subscriber if they came in after the drawdown started.
So that's a great question right there. If you're coming in, so the way that it would work is that the strategy is based on the base sleep well portfolio, not on their portfolio. So I would say it does not matter what they're coming in or when they're coming in. If they're going to follow the selective leverage model, then go with what the actual leverage is supposed to be, not what they would be at, because they're technically at a high water. It's based on the portfolio. So
So actually, this is a good time to start a sleep well portfolio.
oh,
Good.
fantastic. Yeah, like I said, it's a very rare circumstance. I mean, we only get this, 20% of the time when running the sleep well portfolio. We only get a drawdown this low or this much, 20% of the time. So, something else came in the chat. I didn't see it. Hold on, let me look. Oh, that was your link. Perfect.
Yep.
That was the link to the leveraging leverage
Exactly.
roundtable that we did not too long ago. So hopefully that cleared out some of those questions. Like I said, run over to the round table if you want, a really, really, really hardcore in depth. Laz, hopefully that works. Here, we can look at Surge. Surge, let's see, now pretty much stays in range since 2021. It's hard to stay motivated. Yeah, I mean, so so Surge, I mean, definitely, if someone's newer, I should say, to running their own money or not seeing their portfolio, or wanting something that's that's more consistent every month of just up, you'll start to notice with some of those strategies that, like, so say like something that's appealing to a lot of people was something like the road trip, right? And the thing with that is that it lures you in with the whole fact that it's consistently making every month, right? It's like, oh yeah, I'm getting income per month, right? And then all of a sudden it'll get this one fat tail. And so what can happen is all year long you feel really, really good because you're up money. And then all of a sudden 1 month you're just like wiped out for the whole year. Technically speaking, you're flat for the year, but you felt good for 8 months, right? So
that's the iron condor dilemma.
Right. And that's how the S&P is a lot of the times too, right? You're all motivated and happy and go lucky with the S&P while it's climbing and screaming like it's been. And then all of a sudden we get a 15% correction and now you haven't made any money for 2 years, right? That happens. It just happens. It's part of investing. And staying motivated, there's different ways to kind of deal with that on a psychological level and stuff like that. But really, I actually wrote an article about that for the Sleep Well Portfolio subscribers, kind of um, metaphoring back to Odysseus and the Odyssey, and going by the island of the Sirens, right?
There we
And
are with islands again.
yeah, yeah. So wait a second. Did we already talk about this?
No, no, no.
Did I miss it? Did I miss something about the islands, or is it about purchasing the islands?
About buying an island. Yeah.
Yeah, exactly. So, um, yeah, it's one of those things that you put your faith into a strategy, let it kind of do its thing, and then also realize where its weaknesses are. When we look at an equity curve, say something like this, right? We see the future, right? So we quickly glance over any time that it had troubles, right? Because we're like, dude, look how much this thing's up, right? Look how much this thing's up. I mean, if you start doing the numbers here, this started out at $100,000, and it's up almost 6 million over a 12 or 13-year period. So it's kind of like, holy crap, right? But what you had to live through, right, on especially on these leveraged ones, right, before people jump into leveraging and stuff like that, is something like 2018 all the way to 2020, you were flat. That's 2 years of not making money. Right now, we've been, since February to now, it's been flat, with some drawdowns and some chops and rounds. This is totally normal. Like, it's a passive part of the portfolio. Let it do its thing. It'll climb and grow over time. Just kind of set it and forget it. Check it once a week and let it rip, right? This happened in 2015, one of our largest drawdowns right here. If you were to sit here and look at the portfolio at this low, because that's what we're going to do. We're human, right? We're like, oh my God, I'm drawn down. Let me look at this. Oh my God. And then we reverse back in time and we go, my portfolio isn't up any money since, back in maybe 2012 or something like that, right? Maybe that's 2.5 years backwards. Now, you made money prior and then it went away, but that's just kind of how it happens in a campaign sense. And so, like, if someone's been trading options or something like that, they're pretty used to this too. And you sit there and you're making money, and then bam, you start to go on a losing streak, or you have some hard times. And that's honestly when a lot of people start bailing and trying to go find what's hot right now, what's working right now. Which that's environmental trading to an extent, which is a good thing, but there's a failure to that, because if we're trying to run away from pain all the time from just these drawdowns, and it's just part of a strategy, really when we start to choose it from the beginning, sit there and say, hey, can I handle that, right? Can I handle, this looks nice and consistent every year, but can I handle having a time period where I look at my portfolio and for 2 years I haven't made money, knowing that that's the last time I'm probably ever going to see that number, because it's going to grow from there. But that's a difficult thing. I mean, just like in the S&P, if you were to look back at the S&P and you were raw on the S&P and look back, this was 3 years, and yes, you made money before then, but you're flat for that whole time, and it chopped. It's just a different time frame. So we're always kind of battling those demons within ourselves, to manage money and what's right for us and things like that. And the best way that I've learned to combat it is, like I had talked about, which is tying myself to the mast on with like Homer's story with the Odyssey, which is let your crewmen run the ship, which is basically, hey, let the models just do their thing, and I just kind of tie my hands, right? Just kind of let it go and just let it do its thing. And then also another thing that I do is I have multiple strategies. So not only am I running, the Sleep Well portfolio with a large part of my passive portfolio, but then I have active trades. And those active trades keep me busy. And those active trades, keep me all, and I position size those, right? Like, the largest part of my portfolio is much more passive than it is, my active trades. But it keeps me busy, and it keeps me occupied, and it keeps my idle hands from messing with something that's just growing in the background, and I can just let it do its thing, and it works its magic really, really well. And it's a nice balancing, like, bankroll for my bets. And I go through bad times in my short-term portfolio or my short-term trades too, that are, if I were to equity chart them out, they look just like this sometimes, right? They might be higher performers, or they might be different personalities, and they might win when this is losing, which is really nice because they're balancing each other out. And so that gives me a little bit better odds of a consistent win from year to year. I mean, in this data set, if you grab them on calendar years, you only have, I think, one losing year, and it was very small. And I think that was actually 2015 because it snagged right at the end. But if you start looking at it in a sense of how we live through our portfolio, that's when things start to change, because live and versus an equity chart is very different, right? Down in these lows, or when the portfolio has been sideways, like what it was here. So this is a really, indicative time period, or even like right after 2009, we came up for a long period of time, and then we chopped sideways. This sideways with this big nasty dip right here, I mean, this was like an 8 or 9 month sideways run. And then of course we had like a super rip and rock time. And then we had debt crisis, which was even awesome. But before we had these, this year and a half of return right here, we had 8 months of sideways. So it's just kind of one of those things that I look at those types of things, and that's why I put this data out. And I want people to see it. And I want people to look at the equity chart. And I always, people that ask me questions, I'm like, hey, make sure I almost try to like anti-sell the sleep well portfolio. I'm like, look at all of these things that you're walking into. Like, look at the challenges that this has, right? Because it's really easy to sell a holy grail, but those holy grails, they come with some nasty surprises when we don't break down where the risks are. So yeah, I could probably talk till I'm blue in the face to try to kind of somehow like express like how I manage money and things like that. But and all in all, it's to different traders. It's just, that's how it is. I get feedback from all sorts of different traders, and some people are just ecstatic and loving it and are great. Some people are really quiet and they just kind of let the thing do it. And then some people, I will say, get squeamish when it's down, and get squeamish and then get really excited when it's up. And I know that that's really indicative of just an emotional person, and that's actually a really exciting thing, because some people that are emotional are really fun to be around and everything like that. And I know that I have emotional times, or I'm a little bit more sensitive sometimes too, and so I know that can definitely change my trading and investing habits. So it's always a good thing to know about yourself.
And to use that indicator we've got at the top of the homepage,
Yeah.
that's basically when you're doing your new allocations for the week.
Oh yeah, definitely. That's not intro week. Yeah. It's done at the end of the week. Now this will change intro week, right, Tom?
Yep, it changes every time the data is updated every 15 minutes.
Yeah. So, but the way that the strategy is done is the way that this strategy is done particularly is done when it's on allocation. And by the way, this blue line is the one that we're talking about, the selective leveraging. So raw 3x definitely does make more money over time, but the selective leveraging is definitely a smoother ride. And that's just because you're only 2x leverage during the drawdown, and then of course you're 3x leverage, and you can kind of come out of it, and it smooths out some of the chops, right? And it's just a little bit nicer and easier to live through. So, and it actually captures COVID a little bit better. I think it captures the debt crisis a little bit better. But those things probably aren't going to happen the exact same way in the future. So like for instance, quantitative easing ending right here, with bonds freaking out the way that they did, that wasn't like the debt crisis or something like that, or not, at least not yet. So every correction kind of happens a little bit differently. So that's why a adaptive portfolio is so nice.
Let's see, I don't see any more questions.
So
So
to summarize, we're the tortoise, not the hare.
Well, that's what I tell people. It's not a trading strategy. It's an investing strategy.
Yeah, it was designed to be part of the passive part. Now the Awake is going to be a little bit more high flying, and I'll come out with that. Tom, we're probably ready to come out with that. You think what, November?
Well, I mean, the code's not going to be that hard because I'm designing where you can have multiple portfolios. So you just have to tell me when it's ready.
Yeah, so we're probably going to come out in November time frame. That will probably give it enough. It's been live for a little while now in the background with allocations, and we've just been kind of ironing out when to do allocations, when to adjust things. Does it make a difference? Those types of things, and then also making sure that everything's kind of reacting right. It's very similar to the Sleepwell portfolio, so there's not too much to change, but it's faster. It's moving around faster. It's much more aggressive. The thing with the Sleepwell portfolio is like, even right now, we've been moving some allocations pretty fast. The sleep or the Awake has literally gone like all or nothing and many different allocations lately. So it's just a lot more aggressive. And so to do that with a larger portion, say, I mean, it depends on how much people are managing, but with something like 10 plus million or something like that, to be moving that around that fast would be a little bit difficult. So it's meant for smaller accounts. I'm going to run it with something really tiny, like a $2,000 account or something like that, and just run it. And so that way I can show that you can still compound and grow money, kind of like what we were talking about, which is, hey, this is going to be fast and furious. It's going to start out with $2,000 and probably eventually it'll overtake the Sleepwell portfolio within 5 or 6 years. So it'll be fun.
So what's different about the Awake?
Oh yeah, the Awake is a whole nother animal. So here I can here I'll stop share just in case I start showing something that I'm like, hey, wait a second here. Let me go to the Awake forum, and I can kind of pull up what it was. Or you know what, actually I made a PowerPoint discussion about that, and I'll just pull that open.
Oh, and I see a question about multiple account support for allocation. Yeah, if you came in late, then you didn't see it, but I'm building that in the new site. So the database is, the structure is in place to do that. I just have to finish all the coding. Ben, the first rule of Awake is not to talk about Awake.
Nice.
If you tell us you have to kill us, kind of thing.
Yes, I love that. Yeah, it's been a really it's been a deal, right? Awake is more volatile for sure. So let me see. So yeah, Awake is definitely much more volatile than the Sleepwell portfolio in every aspect, right? It's a little bit more change from week to week. Its weekly volatility is a little bit is a little bit faster, but its overall volatility on like a monthly standpoint is actually less. So it's kind of interesting because of its fractal nature. But here, let me share screen again because I'm back. So I made a strategy, or I made a presentation about this to the beta testers that are testing Awake Live right now, and kind of going through it and everything. So what it stands for is Adaptive Weekly Alpha Keynesian Economics Strategy. So it's very similar to the Sleepwell portfolio, except what we're doing is we're really, really leaning on the adaptive portion of things. And how we're leaning on the adaptive portion of things is by using the second derivative of the original models that I use, right? So we have certain models that are sitting there going, hey, we're getting growth, we're getting growth, we're getting unemployment rising or decreasing, or we've got GDP rising, we got GDP falling, things like that. And then we've also got the allocations and the risk allocations and volatility and weekly upside downside and volumes. And so we've got all these overlays that are fractalized and put into a single correlation. And then what we're doing with that is we're saying, okay, what is their, are they is this allocation accelerating? Is this allocation decelerating, right? Is this risk allocation, right? Are the risk models in this asset becoming better or becoming worse? And we're using that, and we're basically attempting to front run the models. And so what the A.W.A.K.E is doing is it's front running the sleep well portfolio is in essence what it is. And so this is the sleep wells portfolio's allocations, and you can kind of tell you can tell these cycles in the market, and this is kind of what's hidden inside the market if no one's kind of looked at the market through a macro lens, right? Is that we've got a time period that is a a slowing growth time period, but yet we've got a strengthening dollar time period through here, right? And so what does that mean for things, right? And you can see it even back here when COVID or when debt crisis, flash crash, which people talked that it was an algorithm thing. No, it's not an algorithm thing. There was definitely problems back here, but there's economic problems in the backside that don't show up, and the news kind of points to whatever random things that they do. But back in 2008, right before this big crash and everything like that, we had high amounts of inflation, right? And then we had the dollar strengthening at the same time, right? And so it's like, well, crap, if you've got a strengthening dollar and high amounts of inflation, or I'm sorry, deflation, and then you've got a currency collapse happening all at the same time around the world, you're like, well, how do you protect against that, right? How do you move an asset for that? And so this is a totally different time frame. And then we had to move into bonds, and then all of a sudden the crash happened, right? And we're like, whoa, oh, that's what was going on. Sometimes we move into something and we're like, well, why am I moving into that? And it's, well, because the models are already shifting that way, and sometimes we're ahead of the game, right? Sometimes we're too far ahead of the game, but that's a different story. We were ahead of the game this time around for quite a while. We'll see if this ends up turning out to something pretty major, but hopefully not. Then the A.W.A.K.E, which is a totally different animal, is way faster. So this is what the A.W.A.K.E is doing is it's taking these overall cycles. You can still see them back here, but then what we did is we overlaid a fractalized calculation on them that's taking them in and out of these cycles, intra cycle. And so that's what we're doing, is we're basically trying to push it a little bit further rather than trying to catch a cycle over the next few months. We're trying to catch a cycle over the next couple of weeks and then shift back out of that cycle in a couple of weeks. But we have this overall deeper cycle that's still happening. So you can kind of see the difference between those two, where it's still the same cycle. It's just amplified in many ways. And so the A.W.A.K.E does perform better over time. It's just a little bit of a different animal. It's meant to be something, more trader based, but still something that can be long only. Nothing that's short, right? If I do a long short strategy, which I've had that and I've worked on it, it's just something that doesn't work in all IRAs because you can't do shorts. So it wasn't something I released to the public, but long shorts, you can make a lot more money. So yeah. Wait, so fractal derived black lit view of macro indicators need. Yeah, there you go. Yeah. So it's like looking at a kaleidoscope in macroeconomic views. Yeah. So anything else about the A.W.A.K.E? What was it?
I don't think so.
All right. Yeah, so this is a lot of fun. This is kind of this back project, and I'll offer this as an add-on service to the sleep well portfolio. So anyone that wants this, that has a so what I did with it is I have like a small IRA that's sitting at someone random, and I'm like, well, here, let me, instead of this just sitting there, let me just transfer this in and let me just use it and have something that's growing at a little bit faster pace, and it's still the same amount of work that the sleep well portfolio is. So it just takes a couple seconds and knocks it out, and voila.
Nice.
So, yeah, it's going to be exciting. And then I'm working on a couple other projects too, and those will come out over the next few months too. Tom and I will get together about that. So yeah. And then perf divided by vol parameters of A.W.A.K.E.
Performance, maybe?
Yeah, let's see. And by the way, like when this all comes out, I'll actually like have it come out, right? We'll talk about it. But as far as that goes, yeah, so the A.W.A.K.E historically does 18.18 and compounded annual growth rate, and it has a weekly standard deviation of 1.85. Here, I'll just pull up my screen again because I realize I'm not sharing. This was all pre the last few months, because I did this presentation a few months ago, so it hasn't been updated since. And the sleep-well portfolio hasn't been updated since either. So about 18.18 CAGR, and then you're looking at a max drawdown of around the same as the sleep-well portfolio. Like I said, it's moving a lot more per week, but its total risk or its total volatility over like a monthly time frame is actually a little bit less. So and you can see that weekly standard deviation is more 1.85 versus a 1.7. And so then of course a reward to risk based on the return versus the max drawdown is over here 1.69, which is a little dark, I realize that, but 1.69 versus the sleep-well, which is the 1.18. So it's a much more efficient portfolio. So it's more of a premium service. So yeah.
All right, Wayne, that's looking good.
Oh, all right.
18% CAGR is nothing to sneeze at.
Yeah. I mean, this is definitely about the sleep well right now. The A.W.A.K.E is something that, it will be offered. But what's nice about that is I will, anyone coming into the A.W.A.K.E from the sleep well portfolio, like I said, it's going to be an add-on. We'll get that at a discounted rate and stuff like that. So it'll be something that'll be nice if you're a sleep well portfolio member.
Now, we do have an RIA trading a few accounts with the sleep well. Is that the A.W.A.K.E an option for them with the RIA, do you think, sometime in the near future?
Yeah, we definitely have to talk to them. It's the same, it's still long only. It's a lot faster, but it still should be the same management and stuff like that. So if someone were to want to push it into A.W.A.K.E, they can definitely do that at our RIA.
Okay. All right, Wayne, I don't see any more questions. Maybe we're pushing an hour anyway, so maybe this is a good place to stop.
It's perfect. Yeah, I was kind of planning on this to be around 30 minutes to an hour, so that's perfect. We'll be back next week, or I'm sorry,
2 weeks.
Thank you, Tom, correcting me.
We're planning this on the 2nd and 4th week of the month, so I think because this was the first time in September is kind of off, so I think the 2nd week in October and the 4th week is going to be the next 2.
Yeah, and if I do think that the next time we go around, we'll probably work on here. Let's set up an actual allocation. Let's set up different things. So yeah, any kinds of questions that you guys want to come across, you can send them to either Tom or I before the next meeting, or you can of course ask live if you're okay doing that too. And thanks everyone for joining in and talking and asking questions. It's always great to have interaction.
Absolutely. All right, Wayne. Thanks, everyone. We will see you all next time.
Thanks. See you guys.
Thanks.